All right, welcome everyone. This is Bob Maurer. It is Thursday, 9th of January, about 12:20ish my time. I want to do a deeper dive into a strategy that was benchmarked somewhat recently. That's the bull spread in coffee, C futures, the world price. 344 is the strategy number, so let's hop on over to it and take looking at the strategy sheet. We are looking at row 3 here, the bull spread number 344. It's the May versus July coffee. And we've got our entries and exits. Dollar reward for both type of entry levels, more conservative entry level one, or if you look at average it. So this is wrong. It's not an 11,000. Take a look at the sheet and or at the charts and correct that. Here we have it. So let's go over the dollar value risk reward here. So 344 bull spread, coffee C, long to May, short to July, margin requirement just shy of $700 per spread. Risk reward for regular entry level, those who only get in at level 2, the more conservative entry level. Risking 413 per spread to either make 1518 or 1893. So that was that typo, 1518. And then for the more aggressive average in traders, per two lot that you might be able to average into, risking about 1500 make either 2360 or 3112. All you do is get level 1 and then it rallies to target 1. The game would be 8. Backstory on this one, it's been a profitable strategy 13 out of the last 15 years. The losing years were 2014 and 2015. And my assessment is that I don't see a whole lot of correlation between the chart you're looking at in front of you there and what happened in 2014 and 15. So, in terms of price and structure repeating themselves, I don't see that. So, that's not concerning to me. The worst case scenario for this strategy over the last 15 years in terms of unrealized loss at any day during the seasonal window was only about $170. And we are giving this thing way more room than that because the benchmark at 625, our stops at $2. The spread is 425 points between these two. Each point in coffee is $3.75. So we're giving it just shy of say $1,600 worth of room. And like I said before, the worst it had been over the last 15 years was only $170. So two things from that. One is that we're giving it enough room. Two is we're giving it this much room because this market is extremely volatile. Okay, it's doing stuff it doesn't normally do. Market's basically been on a tear from the bottom left to the top right of the chart. I'm not just talking about this, I'm talking about the actual futures contract. So we need to respect that. So in terms of volatility, it's definitely amped up relative to years in the past. So even though we look at the seasonal tendency to kind of be in the driver's seat for these strategies, the volatility in the past has been much lower than it is now. So I had to do some calculations trying to take a look at past volatility in terms of percentage moves and translate that into where we're at right now with our coffee market as it is in 2025. So I really expanded the entry points. Let's just put it that way, long story short, out of respect for the volatility. So our first entry point is down here 490. Second entry level point is 310. So 310 is just above this white line, which is the 200 period moving average. Stop is going to be at $2. Okay, and then our targets are up here at 715 and 815. So this market was benchmarked on Jan 21 at 625. So 6.25 cent differential between the price of the May and the price of the July coffee. And it has ground higher, pardon the pun with coffee, but it has ground higher and not a whole lot of movement, but it has been to the upside and it actually reached that first target at 715. But I want to stick with this even though it has, because my assessment of the seasonal tendency is that we look for a break and then this thing rallies back up by the end of the seasonal. So with that in mind, I want to stick with this even though it's already gone through 715. So the theory would be it rallies a bit, then breaks at some point, and then comes on back up. All right. So again, that is the backstory on this one. We've got our entry levels and exit levels. Our risk is well defined. We know the dollar value corresponding to these entries and exits. Got the backstory. So therefore, you are looking at the strategy I recommend. If you have any questions, comments, anything of interest, feel free to let me know. I'm going to leave it there. Thanks so much for watching.